The U.S. economy has just delivered a surprise that very few people were expecting. In the third quarter of 2025, America's economy grew at an annual rate of 4.3%, marking the strongest expansion in nearly 2 years. At a time when many experts were predicting slow growth, high inflation pressures, and possible recession risks, these numbers tell a very different story. But behind this impressive headline lies a more complex and layered reality, one that raises important questions about who is really benefiting from this growth and how long it can last. Gross domestic product, commonly known as GDP, is the total value of all goods and services produced in a country. When GDP grows at this pace, it usually signals strong economic health. A 4.3% growth rate is considered powerful for a developed economy like the United States. It reflects rising economic activity, stronger demand, and increased production across multiple sectors. But understanding why this growth happened is just as important as celebrating the number itself. One of the biggest drivers behind this surge has been consumer spending. American households continued to spend aggressively throughout the quarter. Despite inflation concerns, higher interest rates, and rising living costs, consumers kept buying, from everyday essentials to travel, entertainment, and durable goods. This spending was supported by steady job growth, relatively stable wages, and increased confidence that the economy would remain strong. When consumers spend more, businesses earn more, production increases, and the entire economic cycle accelerates. Another major contributor to this growth was exports. U.S. goods and services saw increased demand from global markets. Technology products, industrial equipment, energy exports, and professional services played a key role in pushing export numbers higher. A more competitive dollar and recovering global demand helped American businesses expand their reach beyond domestic borders. This export strength added momentum to economic expansion at a time when many other countries were struggling with slower growth. Technology investment also played a critical role. Companies poured billions of dollars into artificial intelligence, automation, cloud computing, and advanced manufacturing. These investments boosted productivity and created new business opportunities. The tech sector, already a backbone of the U.S. economy, became an even stronger growth engine. Large corporations increased capital spending, while startups attracted fresh funding, signaling confidence in long-term innovation-driven growth. Government spending further supported the economy. Infrastructure projects, defense spending, and public sector investments continued to inject money into the system. These expenditures helped sustain demand and provided stability during uncertain global conditions. When government spending aligns with private investment, it often amplifies economic growth, as seen during this quarter. However, while the overall picture looks impressive, not everyone is benefiting equally. Economic growth has been uneven across income groups. Higher-income households, investors, and large corporations have captured a disproportionate share of the gains. Stock markets performed well, asset values increased, and corporate profits rose, benefits that primarily favor wealthier Americans. Meanwhile, many low- and middle-income families continue to struggle with rising housing costs, healthcare expenses, and everyday inflation. Retail activity has also shown signs of slowing. While overall consumer spending remains strong, discretionary retail purchases are beginning to cool. Shoppers are becoming more cautious, prioritizing essentials over luxury items. Credit card debt levels are rising, suggesting that some households are relying on borrowing to maintain their lifestyle. This trend raises concerns about whether current spending levels are sustainable in the long run. Another important issue is inflation pressure. Although inflation has moderated compared to previous years, it has not completely disappeared. Strong economic growth can sometimes reignite inflation by increasing demand faster than supply. Policymakers are closely monitoring price levels, especially in housing, energy, and services. If inflation resurges, it could force the Federal Reserve to keep interest rates higher for longer, potentially slowing future growth. Labor market conditions also present a mixed picture. Employment remains strong, but job growth has slowed slightly. Certain industries, particularly technology and manufacturing, are experiencing restructuring and layoffs alongside automation-driven efficiency gains. While new jobs are being created, not all workers have the skills required to transition into these roles, increasing concerns about workforce inequality and skill gaps. From a global perspective, strong U.S. economic growth has significant implications. A booming American economy supports global trade, strengthens international markets, and boosts investor confidence worldwide. However, it also puts pressure on emerging economies by influencing interest rates, capital flows, and currency values. The U.S. economy remains deeply interconnected with the rest of the world, meaning its growth affects everyone. In conclusion, the U.S. economy's 4.3% growth in Q3 2025 is undeniably impressive and reflects resilience in the face of global uncertainty. Strong consumer spending, export growth, and technology investment have powered this expansion. Yet beneath the surface, challenges remain: uneven income distribution, slowing retail momentum, inflation risks, and long-term sustainability concerns.